Welcome to this week's Gig Harbor Market Update. It is December 22nd, just before Christmas, and I thought to give you this wonderful information that nobody else is reporting upon, so you can really impress your friends and your family when you get together for some holiday goodies or treats or get-togethers. So, without further ado, let's talk about what the media is reporting upon and if it could spell trouble and be that black swan that everyone kind of thinks, oh, well, we need a black swan to derail the economy. Well, the threat is there, so let's talk about it and the risk that it presents. So let's get into it. In many of the previous videos and emails that I've written, I've talked about what are the market predictions. Well, you know, this is kind of the middle of the road. This is what, you know, I'm not doing this for clickbait, I'm doing this for actual good information. Now, I've always had the little caveat that, of course, everything can go to hell in a handbasket because of a black swan event. And I've never really been clear about what that black swan event could be. So this is, you know, one of many. It could be another outbreak, it could be a cyber attack, it could be yada, yada, yada. But this is one I think warrants paying special attention to. So where we're going to go is we're going to talk about the bullish arguments about the housing market for next year, and then we're going to talk about the bearish rebuttals against what the bulls are saying. So without further ado, let's get into the specific arguments and see which one is right. And I'm not going to give you the answer, I'm just going to just fill in, flesh in some of the things that are happening data-wise. This entire video I will really just underscore as being luck favors prepared. So I'm not asking you to do anything, I'm just asking you to just consider this stuff and not necessarily react to it, like go install stocks or whatever have you. I'm just trying to make sure that you're prepared. So just like when COVID came out, the people that were like, oh, it's in China and Italy, it's gonna come here, so I better get, you know, food and supplies like toilet paper. Those people were prepared and they were lucky. So as long as you see the writing on the wall and know it's coming and you can react appropriately and not panic, that's the best thing you can do. So now let's get into it. The current market is really a supply issue. So let's go through what the bulls are saying and why prices are going to go up next year. The bullish case for prices going up is that the fact that people have fixed mortgage payments. So a huge swath of mortgage holders have interest rates below 3% or even 4%, and I think 5% is like the 80% mark. So there's no way they're going to sell their house because they won't be forced to, because their mortgage payments will remain the same for the next 30 years. So I know, and it gets less over time, right? So this translates to very low long-term supply, which will result in elevated housing prices going forward for the next few years, because people really don't move from house to house that often, especially if interest rates remain high. The bearish rebuttal to this is that there's more to housing costs than just mortgage payments, and these are commonly known as pity payments and maintenance costs. So pity is principal, interest, taxes, insurance, and there's maintenance on the end of that. So yes, principal and interest might be fixed, but taxes aren't fixed, and insurance isn't fixed, and maintenance costs are not fixed. I know personally the price of trades, so electricians, plumbers, and HVAC technicians, and that has doubled. So once people start understanding those costs are a lot higher than they used to be, this will make their housing payments, their total housing payments, a lot more. So yes, if all things mortgage stays the same but all the other costs go up, some people can be put in a position where they're forced to sell because it's just too expensive to live in the current home they're in. Another bullish case for the continued limited supply is the fact that 40% of homeowners own their home outright, meaning they have no mortgage on their home, and they'll never be put into a position where they're forced to sell. The bearish rebuttal to this is that if a homeowner loses their job, even if they own their home outright, and they can't afford to put food on the table, they will sell the only assets that they have. And this includes the equity in their home. So they put their home to sell. They would be a forced seller to get that equity out, especially if the housing market is falling. They're going to try to sell it before it falls even further. Now, a housing market doesn't quite crash like the stock market, but it does slowly grind down. And if, you know, they're waiting and they're slowly seeing their equity erode and vanish, they're going to be quick to act and put that house on the market. With limited supply expected to continue into 2024, both the bulls and the bears use this as an argument to strengthen their case. The bulls say that if supply is lower and demand is higher, prices will continue to go up, especially as we're seeing the forecast that there's going to be at least 3 rate cuts from the Fed going into next year. Now, the bearish argument is that this low supply is actually putting housing prices in a very precarious position, because if there's a bunch of sellers, they can drive the price of the whole housing market due to limited supply down relatively quickly, just for the fact that they'll be used as the comps going forward. And when more houses get priced, they'll get priced lower because people see that the trajectory of the housing market is going down. So that's a wrap for really just the bull and the bear argument. So the bears are really relying on a recession and essentially as a black swan event. So let's talk about if that's a realistic scenario in this case. Now, before we go into the risk of a recession, aka a hard landing versus a soft landing, let's look at the current cost of housing in terms of income and see if we have any room for prices really to continue to trend up. I'm going to start by looking at this article. It's a New York Post article, but it's citing Wall Street Journal article. So the headline is, it now costs 52% more to buy a home than to rent one. Quote, never been a worse time, end quote. And this was published in October of this year, so not too long ago. Interest rates have come down, but not by much. So let's read. The average monthly mortgage payment is a whopping 52% higher than the average monthly rent on a house or an apartment, a ratio that hasn't been this out of whack since before the 2008 housing crash, according to the Wall Street Journal. And then quoting CBRE, there's never been a worse time to buy instead of rent. And now why is that? Let's go look at this nice little chart they have for us from CBRE. So it's the total monthly payments. The dark blue line is a new mortgage, so the cost of a new mortgage per month, and then the teal or greenish line, whatever, is a multifamily rent. And you can see that it's pretty slow to trend up, a little thing moving during COVID, but if we just establish a trend line, it doesn't really deviate much from that trend line. However, we can see that the new mortgages did spike here, with the housing bubble, and then kind of blew up, and then played catch up here, but it was treading along this rental costs. And then of course we see the spike, and it has come down a little bit, so it did go up to $3,200. It's come down a bit. I think it's like $2,850 per month, so it's still a lot, but the delta between the multifamily rent and the cost of a new mortgage is pretty astronomical. So there's only two things that can really play out if we can say that, hey, both new mortgages and multifamily rent, you do I would track each other, I would say. So either mortgages have to surge, multifamily rents have to surge, or the cost of new mortgages have to come down and meet multifamily rent, as it does probably continue to tick up a little bit, as it just does on a historical trend line. So those are the two options: either mortgages come down significantly back to historical averages, or multifamily has to surge. I'm of the mind that, just based on this data, that multifamily rent is a lot less volatile than the cost of housing and new mortgages, because just it's tied to both the cost of the house but also the interest rates. Versus multifamily rent, you can see is pretty steady eddy here. So I would be of the mind that the most likely event here is that the cost of mortgages have to come down. So that's either the price of the home and interest rates remain relatively stable, or interest rates have to come down. And of course, if interest rates come down, that means that there's going to be more buyers. So we both have to have tight money, so that means that banks don't want to lend and interest rates come down, or we have to have housing prices come down just so we get back to the trend. So that's, what could this be? What could bring us back down to, well, historical averages? Well, there are several outcomes to this graph. I think the most pressing matter is that affordability is a huge issue right now going forward in the housing market. And one great indicator looking at affordability is comparing home value to median income. So let's look at that graph next to see if there's more room for people to pay more, or if they're really maxed out really at their monthly payments. The graph that I just pulled up here shows home value to income ratio going back all the way to 1955, and we can see we really never topped out over 4 times the median income over the typical home value. So we can see all the way to 1955, home values came down when they were at 4, all the way down to 2.5. So even during the crazy inflation in the 70s and the 80s, we still see that incomes were relatively in line with what the median value is to income. So once we reach that 4 times mark, it seems that there's usually a pullback. And because of this is not tied to inflation, nominal prices, real prices, it's just based on income. So what we can infer from this chart is either incomes need to come up substantially and home prices remain the same, or home prices come down and wages keep ticking up slowly. But the Fed also doesn't want wages to go up too fast, because they can enter into a wage spiral where it essentially drives inflation. And they can't control that, because essentially when you have more money, now you can buy more goods and services, and then they get more expensive, and then it's like a evolutionary race really between wages and services. But in this case, we can see that we probably have wages continuing to tick up and home prices coming down. But it's just an interplay of those things. So what could cause home prices to come back down enough to get us back to our median? Well, let's look at that now. So I'm going to read a little bit from my article here. So what could cause that for home values to come back closer to earth is, well, they're expected here to drop by 30% in order to get us down to our historical mean. And so what does that mean? That basically means a drop. So if a house is currently at $335, it dropped to $225, and that's about $111,000 difference. What that means in the value of a home. If the median income continues to stay the same. And of course, when you multiply this a little bit higher, of course, this price will tick up, so the value will tick up, and that'll also get us closer to median. But the two scenarios that we spell out is either wages going up or prices coming down, really relies on a hard or soft landing. And that's when we look at, is a recession a probable or a highly likely event going forward. And so I wrote previously about the inversion of the yield curve, which is basically the 2 and the 10-year treasuries. You can read more about that looking at Investopedia, but it's been a predictor 100% so far of a recession. But people are pretty optimistic now. I mean, in Wall Street, but in everyday people don't seem so optimistic. But what we're currently lacking is a black swan event, to really to rip that Band-Aid off and say, okay, here's a recession or a depression. So let's look what's brewing behind the scenes that the media isn't reporting on regarding the banking crisis of, well, this year, what happened back in March. So let's look into that now. So now let's look at the Bank Term Funding Program. And what is this, and why do we care about it? Well, this tool was created by the Federal Reserve after the GFC of 2008 to bail out banks so we don't have another bank collapse. So it hasn't been used for quite a while. We can go back in 10 years, it hasn't been used until recently when Silicon Valley Bank, Credit Suisse, and some of those banks started going belly up, and they were basically they were giving out loans for banks to fix their balance sheets because their treasuries have gone down in value, and they were having a tough time with their balance sheets because of interest rates going up. The treasuries that they had were paying very little, so the value of the treasury was going down, and basically they were losing their assets. So back in April, March, we had a cap of the amount of the funding that was used was $80 billion. And that was really the end of what we heard in the news cycle. Okay, the Fed had this great tool. It bailed out the banks, and the banks were supposed to get their books squared away in a year. So when they come back and say, hey, Fed, here's the loan back, crisis averted, let's just forget that ever happened. Well, things haven't quite played out that way. And you'd think that, oh yeah, everything's fine and dandy. But what actually has happened is that we've seen a rise since March and April, all the way up to 123. So $123 billion have been used so far to bail banks out. So it's not getting any better. This basically spells something happening in March. Either everything will be taken care of in March, or there's going to be another crisis coming up in just a few months. So that's something that the news quite hasn't reported upon. So while the news might make you believe, just because it has been in the news forever, that this has gone back to zero, it hasn't. And so this causes us to say, is this another great financial crisis happening? Is this the 2.0, or is this a big nothing burger and the Fed will just be able to kick the can down further the road? And that's it. Well, recently, the Fed has announced that they're going to be doing at least 3 rate cuts in 2024. And the market is happy, but also very concerned, is because they thought initially it was going to be 1 or 2 rate cuts. All of a sudden it says at least 3. What is at least 3? Well, they're saying that we might have to cut rates in order to save the economy from collapsing, essentially, or going to recession and try to avert a hard landing. So that means the more rate cuts, as we talked before, as we see with let me just pull it up real quick. Here's the federal funds rate. As we go back in history, you can see every time they had drastic rate cuts, there's always been this, well, not always, I guess here it didn't happen, but there's been a recession that had been tied to, the Fed responding to a recession, trying to stimulate the economy. So it's possible that could be happening now as well, as they see when they look in their beige book, which is, I'm not going to go through it now, it's a whole video in itself. Basically, it's the local reports of the major cities, like San Francisco, and they report what's been happening, economic activity and layoffs and unemployment. And none of them have been too, bubbly about their economy. They're all saying, things are getting slightly worse. So because unemployment is a lagging indicator and a prime indicator of a recession, we're seeing unemployment also tick up. So we're kind of seeing things present themselves as a possibility of a recession. That's the only thing that I'm really trying to communicate here, is prepare yourself, because the writing is there, there's a lot of it, and it's not being reported upon. So if you can situate yourself, I would suggest buying treasuries now while they're still high before rates get cut, so you have a sweet cushion and your money is relatively safe, and you can use that money then to buy cheap assets when it's pennies on the dollar. So that is my advice, is just get ready to buy something at a discount. So what's the worst thing that can happen is, well, you still got your money in your pocket. But so anyway, I gotta build my house quickly and sell it before it goes down in value, it looks like. But of course, I'm just gonna keep going, because we can't control the economy, we can just control how we respond to it. So anyway, I thought that would be some interesting topic you can bring up during your holiday get-togethers. So anyway, Merry Christmas to you, and Happy New Year's. I think I'll see you before New Year's, but maybe not, I don't know. We'll see how the week unfurls. So anyway, have a good weekend, and stay frosty.